everyone, it's Danae Aballi-Mecham here in Orange County, and today I want to clear up one of the biggest misconceptions I hear about the housing market, and that is about the mortgage rates and how they actually work. A lot of people believe that the Federal Reserve sets mortgage rates, and they don't. That's not how this game works. So today I'm actually going to explain 3 things that you should know about how mortgage rates do really move and what that means if you're thinking about buying or selling in 2025 or even 2026. First of all, the Fed doesn't actually set mortgage rates. When you hear the news that the Federal Reserve raised or lowered the interest rates, that affects short-term borrowing, which is things like credit cards, auto loans, and home equity lines of credit. But mortgage rates don't follow the Fed directly. Instead, they actually move based on what's happening with the 10-year U.S. Treasury bond. So lenders use the 10-year Treasury bond as a benchmark because most homeowners keep their mortgages about 10 years before refinancing or selling. So when that yield on the bond goes up, mortgage rates tend to rise, and when that goes down, mortgage rates usually follow. Second thing is the market adds its own markup. Once lenders look at the 10-year Treasury, they add their own risk premium on top of that margin, which is usually 1.5% to 2%. That spread covers the investor risk for loan servicing costs and their profit margin too. So for example, if the 10-year Treasury yield is at 4.5%, that usually translates to a 6 to 6.5% mortgage rate. And that's why rates move daily, because not of what the Fed said this week, but because of how investors feel about inflation, jobs data, overall economic stability, etc. Lastly, what this means for Orange County buyers and home sellers here in Orange County is that we've already seen how sensitive our market is to mortgage rate changes. And when rates dip even slightly, buyer demand surges, especially for well-priced homes in Irvine, Laguna Beach, and some of the surrounding coastal markets. So if you're a buyer waiting for perfect rates, that's actually really risky, because when rates drop, meaning competition goes up, so do the home prices. So sometimes locking in a home you love today at a slightly higher rate and then potentially refinancing later can make more financial sense than waiting with the crowd. And if you're a seller, understanding rates tends to help you price your home correctly and strategically. So you don't have to chase the market, but you should know how buyer psychology shifts as the rates move. So to recap, the main thing is the Fed doesn't actually set mortgage rates. The rates move with the 10-year Treasury bond and market sentiment. And here in Orange County, even small rate changes can have a big impact on buying power and home values. So if you want to know what your monthly payment might look like at today's rate, or how rate trends could affect your buying or selling plans this year, reach out to me and I'll help you understand the numbers specific to your situation, and you can make a confident decision and get to where you want to be.